All right, let's dive right into this explainer. We're looking at the absolute must-know financial and tax rules for any Indian professional relocating to Singapore. Look, moving countries is stressful enough without the tax man breathing down your neck, right? So we're going to unpack the exact strategies you need to seamlessly transition your wealth and, more importantly, avoid some pretty massive penalties. So, moving from India to Singapore? Don't let tax surprises ruin your fresh start. We all know Singapore is famous for its competitive tax system, but hey, that doesn't mean everything is just magically tax-free. When you make the move, your tax residency, your employment income, your Indian investments, and your reporting obligations, they are all going to change. Part 1. The relocation tax trap. Okay, pay attention to this because it's huge. A 3x penalty. Under FEMA guidelines, it is literally illegal for non-resident Indians to hold standard resident savings accounts in India. If you move and just forget to redesignate that old resident savings account, you are leaving yourself completely exposed. The Indian government can hit you with a penalty of up to 3 times the account balance. 3 times. And on top of that, there's a continuing penalty of 5,000 rupees for every single day the violation continues. Immediate compliance here is absolutely non-negotiable. Moving on to Section 2, Singapore Tax Residency Rules. Here is the magic number you need to remember: 183 days. In Singapore, tax residency is all about your physical presence and employment duration. It has nothing to do with your nationality or what kind of visa you hold. If you're physically present or working in Singapore for 183 days or more in a calendar year, boom, you are officially a tax resident. And yes, weekends and public holidays count towards that total. Getting this timeline right is the absolute foundation of your tax planning. Now, why does this matter? Well, let's look at the difference between a resident and a non-resident. If you're a non-resident, meaning you haven't hit that 183-day mark yet, your employment income gets taxed at a flat 15% floor, or the resident rate, whichever happens to be higher. Plus, you get 0 personal tax reliefs. 0. At lower or moderate income levels, that flat 15% can actually be a lot higher than what a resident pays. But once you cross that threshold and become a tax resident, you unlock Singapore's highly favorable progressive tax rates and all those great personal reliefs. And those progressive rates are incredibly gentle. The first 20,000 Singapore dollars you earn, entirely tax-free. From there, the rates just slowly scale up. Starting from the 2024 year of assessment, the absolute top marginal rate is capped at 24%, and that only kicks in on chargeable income over 1 million Singapore dollars. For anyone building wealth, this is a phenomenally attractive environment. Oh, and Singapore uses a territorial tax system. That means they generally do not tax your foreign-sourced income, and there's absolutely 0 capital gains tax. All right, Section 3, FEMA rules for new NRIs. Once you become an NRI, you have to use very specific bank accounts, mainly the NRE and the NRO. Think of the NRE, or non-resident external account, as the home for your foreign earnings. You deposit your Singapore salary there, the interest it earns is totally tax-free in India, and you can freely repatriate those funds back to Singapore without any limits. The NRO, or non-resident ordinary account, on the other hand, is for your India-based income, stuff like rental income or dividends. The interest on an NRO account is taxable in India, and moving that money out is capped at $1 million per financial year. So, what's your immediate action plan? Let's run through a quick checklist. First up, call your bank and convert all your existing resident savings accounts to NRO or NRE formats. Remember that 3x penalty we talked about? Yeah, this is how you avoid it. Second, if you trade Indian stocks, your resident demat accounts have to be updated to comply with PIS or Portfolio Investment Scheme guidelines. Third, don't worry about breaking your existing fixed deposits. Just let them run to maturity, but make sure the bank redesignates them when they renew. And finally, even as an NRI, if you're generating income back in India, you still have to file your Indian tax returns every single year. Section 4. Managing Indian Assets and Property. Let's talk about the cost of ignorance when it comes to property. Say you decide to rent out your old apartment in India. Under Indian tax law, your tenant is legally required to deduct a massive 30% TDS, or tax deducted at source, on your gross rent before they even transfer you the money. I mean, nothing says welcome to expat life quite like losing 30% of your rent up front, right? But there's a workaround. You need to proactively apply to the Indian Tax Department for a lower deduction certificate using Form 13. Securing this little certificate is an absolute must to prevent huge cash flow blockages on both your rental income and any future property sales. Section 5. The India-Singapore DTAA. The Double Taxation Avoidance Agreement, or DTAA, is basically your best friend here. Its whole purpose is to make sure you aren't taxed on the exact same income in both countries. Basically, if you earn income in India and pay taxes there, but you're a tax resident of Singapore, the DTAA lets you claim foreign tax credits, so you aren't paying two different governments for the exact same dollar you earned. It also puts a cap on the withholding tax rates that India can charge on passive income, like your interest and dividends. Now check out this incredible, perfectly legal strategy for Indian mutual fund investors, treaty arbitrage. You see, Indian mutual funds are legally structured as trusts, not corporate companies. Because of that, their units fall under a specific clause, Article 13.5 of the DTAA. What this means in plain English is that solely the country where you reside, Singapore, gets the taxing rights on those capital gains. And since we already know Singapore has zero capital gains tax, your Indian mutual fund gains can effectively become completely tax-free. A recent tax tribunal ruling even upheld this. It is a massive game changer.
Which brings us to Section 6. Plan early, stay compliant.
As we wrap up this explainer, the big takeaway is this: move smart.
Plan early. The absolute best time to figure all of this out is before you pack your bags, definitely not after your first tax filing.
And stay compliant. Proper structuring now prevents massive headaches later. So I'll leave you with this. Are your bank accounts and investments legally ready for your move right now, or are you accidentally leaving yourself exposed to a 3x FEMA penalty?